So we start our next conversation on that note. Real estate companies are facing mounting debt and a liquidity crunch in the NBFCs and MF space. This has hit the sector. Pankaj Kapoor, the managing director of Liasis Foras, and Sunil Rohokale, managing director and CEO ASK Group, have joined us to assess the road ahead for this sector. Good morning, gentlemen. Thank you very much for joining us. Well, first, let me start with Pankaj. Pankaj, we have your report, and you're saying that there is a dramatic increase in unsold stock of homes. Yeah. Can you detail some numbers? I mean, what is the increase over the last, say, 3 years, 4 years?
Yeah, if you look at, we in our report, we have looked at from 2009 till now. And if you look at where the NBFC funding in the real estate sector also has grown. So the unsold inventory in terms of unit has grown close to 3.3 times. From close to 2,60,000 unit, now it is close to 9,45,000 unit in top 8 cities in India. In terms of value, it has grown close to 4.4 times. But what you need to see that the growth in sales has been very stagnant. They have grown only 1.5 times. So in comparison to the sales, the inventory has grown quite many folds. What it clearly indicates that the builder took new commitments, but the growth in the market wasn't there to sustain those kind of a commitment. So if you look at sales is not growing and inventory is growing, that is market was remaining unproductive, and the builder launched new and new projects.
Yeah. Our first issue is to check whether this could become a systemic problem for the debt market. So Sunil, on that note, can you put a value to the amount of real estate property or real estate builders who will be stuck? How much debt may not be serviced?
Okay, so Lata, I think we need to look at the real estate problem in a little differently. And generally, any industry, if doesn't get any working capital, or any industry suddenly finds complete scarcity of capital in any ways, any industry can face a serious challenge. So I'm not taking away the serious problems faced by a real estate industry, but last 5 months, the industry is not getting any working capital which is pre-committed. There is no new money is flowing in. The little bit money which is flowing in, which is actually to keep your existing lines bankable or not become
that is the cause.
So that is a part of the story.
I'm asking you the amount.
So the fact of the matter is total size of the problem of the industry is 5 lakh crore, which is the loan to developers for different asset classes.
From NBFC banks.
From NBFC
MFs.
banks and HFCs put together. Now out of this 5 lakh, around 40%, 35 to 40% is income yielding, backed by receivables, which is in as good as a good quality occupier owned home offices. So that's not really a big problem. So your problem starts with the 3 lakh crore. In the 3 lakh crore, I think the problem is that at this point of time, if you look at the extreme stress to bad, to my guess is a 15 to 20% is bad. So the concentration of 50-60,000 crore is really a concentrated to be dealt with kind of exposure. The problem goes next step, Lata. The problem is not 50-60,000 to the size of the economy, size of the business opportunity looks small. But these 50-60,000 is concentrated with few developers and few companies. So few NBFCs, few HFCs and few banks, if they are going to be concentratedly going to get impacted by this, then the spiral effect of this part is going to be much more uglier than what is anticipated.
I have a follow-up to that. I'm glad you brought that point out, because what we hear is that a few of these NBFCs who are sort of lending the current lines of credit which are going on, even in that, the rates have gone up unilaterally, even for people who are not delaying their payments. Is that true?
Yeah, I think that's not completely incorrect. That is correct to a large extent. Most of these NBFCs have lent with a fixed interest rate regime. They have moved to the variable interest rate regime in between. The cost of funds of some of these guys have gone up. It is passed on 2 to 4% to the current facility. So which is see, neither this 2 to 4% is going to get your money back. Neither the developer is going to service, because he's not going to service at 14%, how he's going to service at 18% is the question mark. So my sense is that I think one of the parameters we need to look at the health of the developer balance sheet is the ratio is not debt to equity like the capital market or a general corporate what we look at. In real estate, one has to be very specific. You need to look at what is the total debt to the sales ratio. Okay, so if the ratio is less than 1, so your total debt and total your sales revenue, the ratio is 1, you are healthier. The moment your debt moved beyond 1, you become anemic and post 2 times. So what had happened is that most of the large developers who probably got a lot of this easy money, cheaper money, in the last 4 and 5 years period, because the NBFCs got a cheaper money from the public sector banks, and then subsequently the capital market mutual funds in specific. So that short-term liquidity problem of the NBFC and HFC is way behind. The real problem is the quality of the book. The real problem is the cash flow improvement, and the real problem is that who is going to take the first haircut. Okay. I think that's more important.
Yeah, let me get Pankaj in on this same issue. How would you agree that it's about a 50,000-60,000 crore problem? And do you also believe that it could spiral because a few NBFCs may not be able to service debt?
To some extent, I agree. But I'm saying that the problem is bigger than that, because if you look at the sales have to grow close to 2.5 times for the builders to, at the macro level, if you look at 4 lakh crore rupees of funding, my overall sales across India is around 2,40,000 crore. And even if you look at the rental incomes from the commercial office spaces is coming close to 9,000 crore. So if you take 2,40,000 crore rupees and take a EBIT of 20%, builders not making more than that, it's 48,000 crore. So 57,000 crore rupees is 48,000 plus 9,000 crore rupees a commercial, like 57,000 crore rupees is what the builders are earning. And against that, there are loan repayment, which is standing 1,25,000 crore. So the macro level itself is suggesting it's a big problem, and it requires replenishment. So question is that we need more money to come into, and then more money has to be cheaper money, so that it can give that. But where would you bring that cheaper money?
So not about, forget about cheaper money now. He was telling us how the rates have gone up by 2 to 4% even for the guys who are repaying on time, right? So I want to ask you, out of the 60,000 crores that is under stress, what about delinquencies? How much could the delinquency rate go up by, say, over the next 6 to 12 months?
Yeah, so I think it is all to do with the mismatch of cash flows. So all the developer balance sheets are running with operating deficiency in the cash flows. My sense is that as banks have gone through a very rigorous exercise of AQR, and you have discussed with multiple industry experts, I also feel that at some stage we also need to clean up once and for all and do the asset quality review of these NBFC, HFC kind of stuff.
It obviously cannot be done now when it's already under stress.
The appropriate point of time.
Yeah, but how many? You would say 5 NBFCs, 6 how many would be
My sense is there is a problem of 8 to 10 of them, okay, in the marketplace, which probably are very, very concentrated on this part. So it's a business mix. If you do not have a mix of retail and the wholesale in a right context, I think the risk what to your balance sheet, risk to your portfolio is immensely more.
You know,
so I feel
we repeatedly get news that private equity or whatever stressed asset funds, some kind of these big pocketed guys can come. These 8 to 10 guys, are you seeing some of them rescued by private equity?
So I think my guess is that, I'll tell you, Lata, my view is that the prices of the projects would see some amount of correction. The developer's greed would have to come down to a very, very minimal level, and he has to be more practical. At the same time, the NBFCs, HFCs, any financial institution given a loan need to be more practical. Refinance is not available. They may have to be more optimistic and more positive to reduce some kind of haircut or delay. Then only the new money will come in. The new money would not find any viability of the project because the project doesn't have margin of safety. And hence, the money would be coming in. My sense is that the credit fund, distress asset funds would come in, gushing in. But to make them really make a business proposition, somebody has to, and everybody has to take the haircut, I guess.
The other big issue is, has supply gone up in the affordable housing segment? Because yesterday we were speaking with, I think, Ujjivan, who told us that there's a complete scarcity of funds. People have stopped lending entirely to the affordable housing segment. A pocket that was, you know, the big project, so to say, of the government, right? What's happening in that space now?
Yeah, I think that is a very different segment. I think the customers are getting money for home loan for prime customers, but the informal economy customers and informal economy homes are actually facing little challenge, because I think we are wrongly been comparing their portfolios with the best of the HFCs in the country. So the 90 days past due, if the best of the HFCs are going to be less than 1%, the affordable housing you need to be more considerate, because their yields are also very different. So my sense is that yes, there is an amount of availability of cash, but that part of the problem is much lesser to my mind than the one which we are currently facing. One more point I just wanted to make. To some extent, what we are talking about, the formal economy getting impacted. But then why every person on the street is a little uneasy and nervous about the real estate? There is the small and the middle income developers who do not get any banking credit, don't get private equity. They are basically unbanked. They are more bankable with the community lending. That part of the money is far larger to the small and the mid developer, and anybody's guess what is that amount is. And that's where generally you talk about very negativity of the asset class in general per se. It's not about only the formal, but the informal lenders also are facing a big brunt because of the slowdown in the sector. And the other part is that this data, what Pankaj has mentioned, this is not a ready-made inventory. Let's be practical. This inventory is at different stages. My guess is that maybe 10 or 15%, one statement is true that completed inventory is improving. And the sale is also improving there. So the luxury is a problem. But first-time home buyer, less than 1 crore market, the sales is happening for a large, good, listed, unlisted developers who are bankable, because the execution is happening.
Good to hear that, some positivity.
Yes.
Are you seeing any private equity money coming in to bail out anybody?
Like per se, I'm not really looking at, but I'm saying that can they bail it out? Like, private equity is going to be costly capital than the capital they have got it. So it's like that you need cheaper capitals. That's why I say that it's like big elephant in a well.
I take your point. It's a little negative. Thank you very much, Pankaj and Sunil, for very quickly detailing to us.
If I can just squeeze in one last question. I know it's hard to ascertain, but any kind of timeline? I mean, how long do you think this crunch would last through the course of this year?
My sense is that the luxury will take a long time. Okay, the first time home buyers market less than 1 crore in non-Mumbai and maybe less than 2 crore in Mumbai, we are actually forming the bottom. So this pain is going to be for this 9 to 12 months time, which is going to be so unbearable, and whoever bears it, I think he will have a good time ahead. So I think that's the point.
Reminds you of 2003, does it?
Actually speaking, 2003 was a very prolonged 98 to 2003. But I think it is more to do with that 8, 9 and 10 where the confidence and suddenly you got caught unaware.
That's better. It's better than, it's so long as it is not as bad as 2009, 2000 and 2002. Thank you very much, Pankaj and Sunil, for joining us in this conversation.
Thanks.